it's much more difficult today. You've got your controllable expenses and your non-controllable. Your non-controllable expenses are taxes and insurance. Both are historically high, and your controllable expenses are higher than most people would underwrite because of inflation. Everything costs more today. On the ground up development side, it's very difficult to maintain margins. The margins that we want to see. You cannot afford to make mistakes today. There's just not that much room in it.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Kip Sowden. Kip is the chairman and CEO of Rreaf Holdings. Kip has over 37 years of experience in commercial real estate with a strong background in real estate brokerage, mortgage banking, acquisition, development, and asset management. And in just a minute, we're going to speak with Kip Sowden about investing in multiple commercial real estate asset classes. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Kip Sowden. Welcome to CRE Radio.
Darren, thank you very much. Pleasure to be here.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, certainly, Darren. So as you pointed out earlier, I've been in the commercial real estate business 37 years, graduated from the University of Texas in Austin in 85, and immediately went into commercial real estate. First 2 years with Lomas and Nettleton in their real estate investment banking division. And then in 87, moved back to Dallas and started my own company, full service mortgage banking company, focused on mortgage originations, debt placement and investment sales, but all third party, fee business, and grew that fairly big, opening multiple offices and, transacting, across the United States, but really wanted to get into the principal side of commercial real estate. And that's what Rreaf Holdings is. Today, Rreaf Holdings is set up in 5 main verticals. Multifamily is our largest. In that particular vertical, we're buying existing multifamily assets throughout the southeastern part of the United States. Today, we own some 60 communities, 15,000 units, completely vertically integrated as a company. We have big, robust, acquisitions group. We have underwriting due diligence teams. We have our own property management company, RR Living. Not only do they manage our 15,000 units, but they also manage for our competitors, another 5,000 to 10,000 units for, third party management assignments. We have Rreaf Development Services that goes out and finds, land to develop and titles it. And then we have Rreaf Construction Services that acts as a general contractor and is not only building several of our multifamily communities, but also does it for third-party clients. We've got, in-house legal, we have our own title company. So we really are vertically integrated as a company. And I mentioned just one of 5 verticals. Another vertical is our beachfront hospitality and resorts. In that vertical or that division, we're buying existing hotels in iconic locations, obviously on beaches. And that program has a very heavy capital improvement component to it. In some cases, we'll take the facility back to its concrete frame and rebuild it, all new, electrical, plumbing, HVAC, FF&E, and a heavy emphasis on, the customer experience, putting in a lot of amenities, lazy rivers, resort pools, family entertainment centers, restaurants, and the like. In that vertical today, we own 2 hotels on Panama City Beach, 1 on Pensacola Beach. We just finished building a high rise on Pensacola Beach that was awarded the top 5 new resorts for 2024 to visit by USA Today readers. Very thrilled about that, and a number of development awards. We're on Cocoa Beach, we're on Surfside, Hutchinson Island, bought 2 hotels on Amelia Island in that vertical, and we own the Sea Palms Resort on St. Simon Island. And I can keep going. The third vertical is our Rreaf communities, and that's interesting, and I believe will be our largest vertical soon. Rreaf communities is literally, Darren, building cities. We'll take down large tracts of land in close proximity to major high growth MSAs. For example, we bought 3,200 acres just south of where I'm sitting here in Dallas, Texas. 50% of it is in Midlothian. The other 50% is in Waxahachie. There, we've designed 8,500 single family homes for sale. We will develop, about another 3,000 rentals between single family, BTR, build to rent communities, multiple multifamily communities, townhouse projects. We're putting a beach in. We'll put in the town center. We're our own taxing authority. We've got the MUD in place, municipal utility district, where we'll develop the wastewater treatment facilities, bring police and fire. We're creating 2 schools, creating cities. We're doing within Rreaf communities another development equal in size. It's 3,300 acres, halfway between Austin and San Antonio in Texas, at the Texas 130 tollway and Highway 80, just high growth markets. It's Caldwell County, which you probably know half of California is moving into Caldwell County, but it's the same type development. And then we have a 4th vertical that is extended stay. We're developing extended stay hospitality all over the country. We've done quite a few Wood Spring Suites, some Everhomes, some extended stay America Premiers. We're doing a lot of the Hyatt Studios and the Marriott Hilton product, but we love that space, and we're geared to, develop, build anywhere from 10 to 15 of those a year. And, we're all about scale as a company. We won't look to exit any of our verticals, until we've amassed well over $1 billion within each of those verticals. We're there in multifamily. We're there in the beachfront hospitality and resort. We're there in Rreaf communities. And, we're growing the extended stay platform. And then our last and newest vertical that we launched in 2023 is what we call Rreaf Outdoor Living, or outdoor communities. And we launched that with the acquisition of 5 RV parks, 3 states, Texas, Alabama, and Florida. And, we're really creating a new category within that space by taking our hospitality expertise and kind of blending it in with an RV community, where we're coming in and, putting in major amenity packages, the lazy rivers, the resort pools, the family entertainment centers, the restaurants. We're taking some of the RV pads up to 25% and putting in the tiny homes to open up that space to non-RVers, basically a horizontal resort. As a company today, we're about 4.6 billion in assets across those 5 main verticals. And I think we're up to about 550 direct employees operating in 16 states. And then a sixth vertical that we've just launched is not for profit. It's our giving and Rreaf charities that we're really growing to give back to the community. So that's Rreaf Holdings today.
Wow, that's a whole lot there. It's
But there is
impressive too.
a common denominator to all of it, which is that we are really catering to middle America, the largest population base, both on the hospitality side and all things residential. It's, catering to middle America.
Got it. So they're the tie together there. So how old is Rreaf? When did Rreaf start?
Well, I say our roots go back 37 years. They go back 37 years with me, but Rreaf as Rreaf really started in 2009, late 2009, early 2010. And I'll tell you, it was really created because we thought we would see RTC2. And so Rreaf used to have a tagline that said real estate note acquisitions, and thought that we would see some community regional banks having to dispose of assets, and we thought we would come in and buy notes secured by commercial real estate, presumably at discounts, do workouts, worst case scenario, foreclose, take assets and manage them up. We went and met with some 80 community and regional banks throughout the South, Southeast. But at the time, if you recall, the Obama administration was, or the feds were not really forcing banks to really mark to market their real estate holdings. And I think that was probably a good call. I mean, a lot of these banks, their tier one capital ratio at the time was 2.5 to 3, maybe 3.5%. Had they really marked their real estate values to true valuations, feds would be in shutting down those banks. So you saw very, very much fewer, bank foreclosures in the RTC or bank shutdowns from the RTC days. And, that I don't want to say look the other way, but, eventually, the tier one capital ratios came up. Banks were able to start trading assets and adjusting their portfolios, and our phone started ringing and we started buying. So first deal we did was actually a property on Panama City Beach that a bank had foreclosed on, and that launched Rreaf in 2010.
Got it. No, definitely a kind of a mirror of what happened. When was that? Late '80s when they the was real estate, or what was it? I'm trying to remember.
Resolution Trust Corporation, and that's right. I mean, I've been through 7 cycles in this business.
Yeah. Well, I just I remember that from a standpoint of I was still in college, but I remember the kind of just some of the notions of it, and since have come to recognize multiple real estate investment firms that they got their start then, buying assets at significant discounts. And I remember watching the whole, seemed like there was Senate, I don't know, it was Senate hearings, or there was some sort of hearings and stuff. And I can't remember who was the Fed
chairman back then.
Yeah. Bald guy.
Yeah, I've got it pictured, but
yeah, and his son owned the Portland soccer team. I can't remember his name right now, but anyway, I remember in the way he was laying it out, I thought for sure this was going to be like create a marketplace for all that happening. Instead, it seemed like what they did is they just applied all the banks with cash so they could meet their reserve requirements, or
that's right,
as opposed to liquidating.
That's right.
And like you said, I think hindsight is 2020, but in the looking forward at the time, and trying something new on that scale, lots of uncertainty, but it like you said, it didn't create the havoc that could have been created. I mean, there's plenty of foreclosures and bank, distress sales and all that. And some banks did. I mean, some of the biggest banks, uh, got shut down there. But just it really kind of gave an eye to see just how fragile the economic system can be if capital stops, if capital is not available.
Well, that's right. Capital drives everything, both debt and
Yeah,
equity, just the whole capital stack. And it's become very challenging, quite frankly, of late. But,
right.
I will say, you've got to focus on location. Location matters and asset class matters. And, Rreaf is really set up, as I said earlier, it's south, southeast, high growth markets. It's, where, there's great in migration and there's a huge shortage of housing, throughout the south, southeast as people continue to move here. Um,
Yeah,
and, demand far exceeds supply. So it's the economics continue to make sense. Same thing with drive to leisure hospitality. I'm looking out my window in Dallas. I mean, there are cranes everywhere. I mean, it's growing, growing, growing. And you're seeing more and more of that in the south, southeastern part of the United States. So, I'm not going to say that, I mean, in commercial real estate, I don't believe anything is recession proof, but I think that, there are certain asset classes in certain areas of the country that are recession resilient. And we're certainly seeing that in our platforms. All of our properties are, making money, high occupancy, and, our investors are very, very happy. And we continue to grow. I
yeah.
failed to mention we've got about 1 billion under construction right now.
Wow. And is that in the community type thing, or is that just across
So
the board?
we're
Or
building two big new resorts, a Margaritaville Resort on Galveston Island, 334 keys, all podium built, very, very high end amenities, 5 restaurants, several bars, lazy rivers, water park. And then around it, we're building 278 cottages, but these cottages we expect to sell at 900 a foot. So, on averaging, over $2 million each. And there's just tremendous demand. We've got 21 million people within a 4-hour drive of this beach on the Texas Gulf Coast. And we're also building a Margaritaville resort, very similar, on Myrtle Beach. And then we've got 4 or 5 apartment communities under construction in Texas and just completed some in Tennessee, but also, growing.
got it. So you mentioned Middle America is kind of the demographics that all of your uh, different asset classes focus on. How do you, when you describe Middle America, is that an income level? Is that I mean, how do you guys
It's
define?
affordability. We
Okay.
want very high quality residential areas, that most of America can't afford. I mean, we've got communities that are renters by choice, but then we have plenty that are, catering to the, workforce community, the teachers, the firemen, the, police, and, in our build to rent communities that are really, really growing today, we're seeing a shift in demographics from, younger generations that are not, um, necessarily, wanting to buy their first house. They can afford to buy a first house, but they're more transient in nature and want to, live or try out a community before they've actually committed to buy and have the flexibility to, move around. We're also seeing first time home builders that with where interest rates are, priced out of the market and are forced then to, rent, but they don't want to live in an apartment community. So we provide that product as well. In our BTR, the build to rent, program, we focus on 2 main criteria. One, are you within a 20-30 minute drive of a major metropolitan statistical area? And 2, and most importantly, what is the rating of the independent school district? We want exemplary. We want best, ratings for the school system, catering to families with children.
Got it. And that's that two quantifiable things there. I mean, growing MSAs with strong schools. I mean, that's
That's
really hard
it.
to screw that up.
Yeah, that's right.
Yeah, you got
And then
that
on
going.
catering to middle America, it's the drive to leisure. I mean, we're not catering to the, families that are flying in their private planes and paying $600-700 a night, to be on 30A in the Florida Panhandle. 3 miles
Right.
down the beach, people will drive in their, Suburbans with their children and, pets and come spend a week or 10 days, exact same beach, same water, and have an unbelievable, experience, but they can afford to do that. So
Yeah,
we're really catering to middle America in that respect.
got it. So tell me a little bit about the similarities or the differences between more of the housing as opposed to more of the lodging, like the resort communities and that. Are you guys vertically oriented or vertically integrated in all asset classes?
Well,
Or
that's a good question. We believe that, being vertically integrated, if something doesn't go right on one of our, projects, there's nobody else to blame but ourselves. And, we think that, particularly on the management side, we get better execution, by, owning the management company. We teach our property managers to focus on not just the top part of a P&L, the revenue side, because your management fees are, a percentage of your revenue, but to also focus and concentrate on the bottom half of a P&L, the expense side, to really create those returns for our equity investors, which are the lifeblood of Rreaf. And it's much more difficult today. You've got your controllable expenses and your non-controllable. Your non-controllable expenses are taxes and insurance. Both are historically high, and your controllable expenses are higher than most people would underwrite because of inflation. Everything costs more today. On the ground up development side, it's very difficult to maintain margins. The margins that we want to see. You cannot afford to make mistakes today. There's just not that much room in it. So we like being vertically integrated because we control all aspects of, a development project, or, when we're acquiring, real estate, to the economics. We know how to lease. We're believe highly in scale. So every market that we're in, we're going to dominate that market. I mean, we do mostly portfolio transactions. So if you were to look, for example, on our website and pull up the map, you'll see we'll have, 10 communities, within a 30-mile radius of these markets. So scale matters.
got it. So, but again, to the vertical integration on the hospitality, are those your employees that are running the hospitality, or do you lease those properties to operators?
Very good point, or good question. We own and operate the hospitality, assets. On the property management side, we've set up our own property management company in a joint venture with an outfit out of Memphis for the extended stay platform. We couldn't find a good third-party property management company to manage the extended stay vertical. So we built out our own extended stay property management company. New company, don't even know that it's officially been announced, but it's MXR, and they will not only manage our extended stay, but we'll do quite a bit of third party management in the extended stay space. As it relates to our beachfront hotels and resorts, the very, very best in the business is a company called Innisfree Hotels out of Gulf Breeze, Florida. But they're not really third-party property management company because they co-invest with us in everything that we, buy. So they've got a vested interest, and our interests are aligned. So that too allows for that vertical integration. Every single asset that Rreaf owns, we asset manage. Different from property manage, but we asset manage. And
Right.
of all the verticals, We have property management companies, except for Innisfree that manages the beachfront hotels, but our interests are aligned because they're co-invested with us in those assets, co-owned.
Got it. Got it. No, I was just sitting there thinking a little bit about the different asset classes and I mean the structure, the building, the capital improvements and all that seems to be fairly related. But the actual business operations of, long-term rental as opposed to a nightly stay kind of thing with restaurants and all that, I could see that being a little bit different and might require some different skill sets or just a different approach to achieve the goals in that.
That's
Um,
exactly right. I mean, you think about it in the hospitality business. I mean, you're waking up virtually every day vacant.
yeah,
Well, you've got to
yeah,
release it to 100%. And again, that goes back to making certain that you're choosing the right markets, picking the right asset, and have the right basis in that asset.
right, right. No, and just even the marketing and somebody to answer the phone or reply
That's
on
right.
online and that the everybody is happy to click. But if you don't respond to that warm lead when it's warm, it goes cold really quick. And so it's just to recognize the differences there.
Yeah,
Um,
100% correct.
yeah. So you mentioned investors. How are you with the different asset classes, the different properties? Do you guys have a fund? Are these one investment, one set of investors, kind of a what am I
Every
trying to say?
vertical is a little different. In the
Okay.
multifamily vertical, for example, our last three transactions have been all over 500 million. And that is our acquisition teams going out and aggregating multiple properties or multiple portfolios from different owners to create an LLC. And most of what we do in that particular vertical, we're leveraging with agency debt, either Fannie Mae or Freddie Mac. We're risk adverse as a company, so we typically lock in long-term financing. By way of example, TC21, Transcoastal 21, it was multiple sellers, but we aggregated 21 communities into one closing. Round numbers, about 600 million, 21 different loans, but all 10 years fixed from Freddie. That deal was closed in December of 21, and our interest rate is at 2.71% fixed for 10 years, and we had 6 years of IO. So, just great execution. We have some institutional investors that partner with us. 3650 is one, which is a REIT. It's CalSTRS, New York Teachers is some of their bigger investors. And then we've got retail investors, probably 2,000 active investors that are investing, in Rreaf and common equity that have, brought us several hundreds of millions. Some investors might start with just $50,000 in one deal, but that same investor today may have 20 million with us in multiple deals, and it's really grown organically, and that just comes from the way we transact and doing what you say you're going to do. I tell every investor the most important thing that you could ever do is investigate and understand who the sponsor is. The real estate less important, the sponsor very, very important.
Yeah.
uh,
No, absolutely. Kind of someone where the buck stops with
that's right.
kind of thing. So tell me a little bit more about the exit strategy. You mentioned a billion in any asset class before you consider um, selling. Is or typically are you when you acquire uh, assets, is it more of a long-term hold
no
until you
i
build it to a
no I mean, typically, I'll give you an example. Our typical hold is 3 to 5 on all of our LLC deals. So 48 months would be right in the middle of that. now with where we are in the cycle, it's probably 4 to 6 years. So 5 years would be, kind of the middle of that. We have, for example, in our multifamily portfolio, we've exited some 37 deals, 800 million in total. Average return to our equity investors was a 2.01 multiple on their equity and a 24% internal rate of return on an average hold of 3.5 years. In any deal that we're buying, we're kind of underwriting, for those kind of metrics. So
Yeah, no,
that's average.
that's a strong endorsement of your what you've been able to do.
That's
Uh,
that's 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 what allows us to grow. I mean,
yeah,
that's why investors keep coming back.
sure. So, last 10 years have been pretty dynamic. Having, pre-COVID, COVID, uh, very, very, very inexpensive money, to where now, it's historically, I don't know that it's, off the charts, but it feels punitive compared to where we've been. What are you seeing now? Are you guys, is it more of lots and lots and lots of deals kind of kicking the tires, trying to find things to make them work? Or are you finding deals where, the seller's in a position of they've got to either sell or refi, and some of the opportunities and the pricing is starting to make more sense?
Yeah, so that's a lot of questions. So in 2021, just by way of example, we transacted as a company across the five verticals about 1 billion in deals. In 22, we transacted 1.3 billion. In 23, it dropped about 300 million. And in 24, it's probably going to be in that 250 to 300 million range. The reason is that there's a disconnect between, what sellers' expectations are and where we see the market. And sellers that are not forced to sell shouldn't be selling. We're going to
Right.
underwrite today at 5.5 to 6 caps on trailing numbers. And with where debt is today, we want positive leverage, at worst case, neutral leverage, but we're not betting on the come. We want to underwrite, what is the market value of an asset today. So it's been slow to transact because sellers that were not forced to sell aren't selling.
Right.
Now, second part of that is that we are seeing it open up some, and that, a number of our competitors or sponsors, that were buying, in 21 and 22 that were not putting long-term permanent debt on, were using bridge loans. They're getting in trouble. Those were floating rate loans that they were, used high leverage with the idea that we're going to ride this growth up. It's never going to stop. Our rental rates are going to continue to, grow by double digits. We're going to, then we're going to increase our NOIs. We're going to roll out to agency debt, return our capital, and look like heroes. Well, that didn't happen. Rental rate growth stopped, interest rates went up, and a lot of these sponsors don't have the wherewithal to withstand it long. And so we're starting to see some of those opportunities shake free. And,
Yeah.
you know,
Well, and that's I think one of the things I've come to appreciate and understand more. I know earlier in my life I didn't appreciate it at all. Was the dynamics of the marketplace, specifically with um, interest rates, and the rise and fall of the market, kind of thing, and that the opportunity exists in the chaos. A lot of times, and there's losers that allow others to be winners. And
that's right.
I think the thing that I've come to recognize more is that having enough dry powder or capital to withstand those difficult times and be in a position to take advantage of some of others' misfortunes is really how a lot of in real estate wealth is made. And it's again, it's unfortunate if you're on the selling side of that deal sometimes, but it's part of the marketplace, and it is it repeats itself over and over and over and over again.
It does. History doesn't lie.
Yeah, yeah. And I think the other side too is recognizing when you have enough profit, rather than waiting for more, sometimes it's better to get out, bird in the hand is worth two in the bush kind of thing. You don't try and time it so much, just kind of hit your targets and allow for enough time cushion to meet your goals in that. But
I think
just
that's
some,
right. I mean, I think that it all boils down to the sponsors. I mean, there's
yeah,
those that'll do well in good times and bad times, and those that can do well or do okay in good times, but in bad times are not going to do well.
yeah. So given that the deal flow is slowed considerably compared to what you were doing earlier, are you finding that this is a good opportunity to build out some of those projects that you've these larger community projects? Is that
It is. Those larger community projects take considerably longer to build out. You're not
right?
you're basically taking ag land and entitling it, and getting all the water and the sewer and the rights, and that's a 3-year process. I mean, we've been battling the cities to be able to get our MUDs approved, and TCEQ approvals, and but once you get through that process, you've created just tremendous value.
Right, right,
And we also look ahead. So we're a company that's very data driven, and we are forecasting where markets are moving, and we try to stay ahead of it. And so even in these slow times when a lot of companies are laying people off or shrinking, we're building, we're growing, we're hiring, we're preparing for the next wave and training. We have our own training programs. In fact, you can go to YouTube and type in Rreaf Academy, and there'll be 30, 40 hours of lectures on real estate from our department heads in our conference room, training folks on, different areas of commercial real estate. And we have a very robust training program here. So anyway,
I think that would be really powerful with as many employees as you have, and trying to maintain culture and all that. So that's great.
uh,
Um, I'm curious on the communities. I mean, literally, basically, you guys are creating cities in that.
that's right.
Um, of that, the acreage you mentioned, 3,200 and 3,300, I think,
That's right.
acre sites. Um, is all of that essentially housing, or do you also then have? I mean, as I ask this question, I realize it's silly. Is there a way to identify kind of a percentage need for like the retail office as opposed to housing and those types of
There are, yes. And, it's a master planned, community. And
right,
so it's all about live, work, play. And we're big believers in, lots of green space, lots of trails, lots of hiking, biking, and trees. I mean, we're creating, living environments quite different than the way they were, built in the 70s and 80s, 90s, and so on. I mean, a lot of entertainment, a lot of green belts, walkability. Each of these developments has commercial components to them, with restaurants and retail and lots of hiking, biking trails and soccer fields and schools, and but they're still in close proximity. If you want even more, you're 20, 30 minutes to a population of 2 million plus, and in this
right,
case 8 million in
right,
Dallas
right.
Fort Worth.
No, it is a different animal, the development cycle, as opposed to identifying an existing property and closing in 90 days or something like that. And but just the foresight and the planning and all that, I mean, it's just a different timeline.
It is. And
But
you brought it up earlier, and I could kind of expand a little bit about being vertically integrated. Huge asset, particularly when we're buying and underwriting a particular portfolio, because we can act much quicker than our competition because we have all the disciplines in house. So when we go to a particular property, we've got asset management, we've got property management, we've got Rreaf construction services, all there at the same time doing different, deals. We don't typically buy assets that are actually listed for sale. If a Cushman, a Marcus Millichap, CBRE, Jones Lang LaSalle, or any of the big boys, have these portfolios out in the market, we're not going to be the winner. I mean, because we buy value. And what a seller gets from us, and we have this reputation, they get certainty of execution and we can execute quickly, but we get paid for that. So we're probably buying at, 80 cents on the dollar, maybe, and we tell a seller, look, you could do better. If you don't need to sell, don't sell to us. You could do better listing them. Now that process might take you 4 to 6 months. We'll close it in 30, 45 days, but this is our price.
yeah, well, that certainty of sale is definitely worth something as opposed to the if. And then
Right.
even in that time, you never know what could happen. Interest
That's
rates
right.
could take another spike, and the deal could fall apart there. So that's good. Hey, Kip, if we could, I'd like to shift gears here for a second. As I mentioned to you before where we started, by day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be clients, the Fed, investors, global market, local politics, whatever you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Kip Sowden, what is the biggest risk?
I think that, with every investment opportunity, there's risk and reward, right? And so we're always looking for, ways that we can, mitigate risk and generate, outsized returns given the risk profile. And I think that a lot of that's done through, our vertical integration, as we discussed earlier. And I think a lot of it's done through, on the commercial real estate side, it's done through, the, asset classes that you're in and the locations that you're in. I mean, if you're, buying and developing in markets where demand's exceeding supply, you certainly lower that risk and you create theoretically, better positive returns, right? And so it really boils down to, the sponsor doing their diligence on the underwriting, but there are, things that you don't count on or don't foresee, and how do you deal with those? You mentioned and being in the insurance business. I mean, as well as I do, insurance is at an all-time high for all, product, type. And it's something we've got to deal with every day. I doubt there's any sponsor that underwrote both taxes and insurance on their P&Ls to the levels that they are today. And can you offset that on the revenue side? You've got to be in the right asset classes, you've got to be in the right markets. And you've got to have, room in your underwriting to account for the unaccounted, for the unexpected, I should say. And I think that Rreaf does do that well. When we have things that we didn't underwrite, I want to make sure that, we're not throwing off a 15, cash on cash return. We're throwing off an 8, which is still good. and you have those kind of misses. We're also, we don't have to sell. I mean, we're not a fund that has timelines. So we're going to sell and buy when it makes sense to sell and buy. And, I think all of those things help mitigate the risk as people look at investing in, commercial real estate. But insurance and taxes, higher than they've ever been.
Yeah.
And I think they're very, very important. You got to have them.
No, very important, but it's not the cherry on top kind of thing when you're, I deal with it every day, but it is what it is, and I think it's just I think there's kind of some adjustments that people are having to make, and whether it be budget and or kind of levels of coverage, et cetera.
That's right.
But it all plays out. But
It's all part of the underwriting process.
yeah, definitely a more of an emphasis on the insurance side today than 5 years ago when people were telling me what it should cost.
Right.
And I get it. Hey, Kip, where can the listeners go if they'd like to learn more or connect?
Our website's a good starting point, which is www.rreaf.com. It's RREAF.com, or reach out, email kip@rreaf.com, and I'll connect you with the appropriate departments to learn more.
Got it. Well, Kip Sowden, I cannot say thanks enough for taking the time to talk today. I've thoroughly enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, I've enjoyed it as well, Darren. Thank you very much for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Till next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.